Ladies and gentlemen, let me give you a warm-hearted welcome to today's WebEx call on BB Global Macro, named Performance Review and Market Outlook. My name is Phil Steiner. I'm a Senior Sales Switzerland, and I'll be moderating this call. Should you, for any reasons, not be able to see the slide decks within your WebEx browser, please send a short or an empty email to pfi@bellevue.ch. The presentation will be sent to you right away in reply. I do repeat the email address. It's pfi@bellevue.ch. P like Patrick, F like Foxtrot, I like India, @bellevue.ch. Your lines are muted. However, should you have any questions, feel free to put them into the integrated chat function. If not answered during the call, all questions will be answered during the day. Either way, in case you missed something, the recorded call will be provided to you additionally later on today, tomorrow morning latest. With me in this call are Markus Peter, Head of Products, and Lucio Soso, the Lead Portfolio Manager of BB Global Macro. Without further delay, I'm now handing over to Markus Peter first, then to Lucio Soso. We will get an overview of what happened year to date, where we will elaborate on the drawdown, including a Corona update. We will also see, though, how extreme specific assets have been priced, what excesses we have seen, being not shy to be compared with the financial crisis 11 years ago. Having said that, Markus.
Thank you, Phil. Dear ladies and gentlemen, I would like to welcome you in these pretty difficult times to our WebEx call. As already indicated, we would like to give you first a short overview on the current coronavirus situation. We have today 218,000 disease cases, and about 37% of these disease cases come today from China. So you see there is a big shift that these cases now preliminarily occur in Europe. We have 8,800 patients that died. In China, we have actually 3,249. That's also about 37% of the cases. And we have 84,000 recovered patients. So that's certainly also positive news. Then the death rate is about 3%. And we have mostly elderly people that are affected and people with pre-chronic diseases. The symptoms are similar to those of a normal winter flu. Later, cough and shortness of breath are added to the symptoms. You have all seen the very proactive measures of different governments over the last few days. We would like to give you first a short overview on why this is necessary. The primary aim of every government is to be in a position to treat all critical cases at all times. And to do that, you have to be proactive and to reduce the peak case numbers that you would get without any measures. If the peak cases are too high, the hospital wouldn't be in a position to treat everybody in a correct way. That's a situation that you see, for example, in Italy today. The lockdown measures that are taken have also a negative impact on the economy. And you see now a lot of interventions also on the monetary side and on the fiscal side over the last few days. The below chart shows you that different states are in different situations in the whole cycle of this coronavirus. We have, for example, the UK and the US that are just at the beginning of this cycle, and they have already taken stringent measures. We have Korea, Italy, and Iran. They are already in a quite advanced stage with a lot of infection cases. And we have Switzerland, Germany, and Japan that are reporting a rapid rise in coronavirus cases and are taking decisive action. China, on the other side, has passed the peak of the coronavirus epidemic, and there are very few new cases that are reported from China at the moment. Now let's have a quick performance overview what happened in the financial markets. This chart shows you the volatility index VIX, and you see here that we have reached very high volatility levels of above 80%, which clearly is a very high level, also if you compare it to the financial crisis where we have reached around the same levels. Since end of February, we have also equity markets really selling off. You have here the year-to-date performance of different markets. In Switzerland, we have lost about 20%. In European equity markets like Euro Stoxx, DAX, FTSE MIP, it's around 35%. We also entered bear market in all the equity markets, and this only took us 16 days. So you see the corona crisis was really one of the fastest crises that did bring us in a bear market environment in the equity markets. Unfortunately, also the fund has a drawdown of 10% in March, and year to date we are down 13%. Let's have a look on the different strategies that materialize this drawdown. We have the equity strategies that are negative by 6.5%. We have the dividend future strategy that Lucio Soso will especially elaborate in this call. This strategy is down 2.8%. And we have the high yield strategy that is down 1.9%. You also know that we have been and still are 20% short in US Treasuries. But you see that this short did not have the biggest impact on the whole situation. It's more a lost opportunity than that we have a big impact from this situation. We have a negative return of 1.4% on government bonds. That's a summary on the performance. And now I'm passing over to Lucio Soso.
Good morning, ladies and gentlemen. This is Lucio Soso, the portfolio manager speaking. I would like to show with these three charts what we have done in the portfolio, and then I will explain why we have done it. So the top chart here is the equity exposure of the fund. The red line is the net exposure, and the green line is the gross exposure, that is long plus short. So if there are short positions, you can see a green line. So we started the year with an exposure of 26%. As of the end of January, we had an exposure of 23%, so which is lower than a long-term average of 27, 28%. And when the crisis started, we waited for about 10 days, and then we started buying slowly. So that towards the beginning of March, we were around 27. And when you see the red arrow, that's where we increased the exposure for 26 to 33. It was March 11, 12, and 13. We did that by buying some dividend futures and other themes, and by closing the short positions and taking our profits there. The chart in the middle is the exposure to the non-government bond part, so the high yield bond exposure. And here we basically kept the portfolio unchanged at around 14.3%. We are currently at 14.6%. The few moves that you see in the line have to do with switches, and also with the fact that I mean the scale here is very sensitive. So but we basically changed little in our exposure. And finally, last but not least, we had a 19% short exposure in U.S. Treasuries that Markus mentioned. And we still hold the same position, which is now 22.7%, because the equity portion shrank and the government bond portion increased, but it's the same position basically. Within the month, we did some trading in German treasuries, which resulted in zero performance, neither positive nor negative. So let me explain a little bit better what happened. I think this is clearly disappointing. This is the largest drawdown that the fund has experienced. We had previously in 2011 we had a 6% drawdown month on month. Within the months it was -9. The difference is that in 2011 we recognized that we were wrongly positioned, and so we took our losses, and that resulted in a more controlled drawdown. But if you look at our long-term performance, it also resulted in a very long recovery time of more than 2 years. In this particular situation, we walked into this correction, which we analyzed wrongly, but we had an exposure of 23%. And once we realized that this was going to be bigger, we took the view that we were going to not only hold the position, but gradually increase it. So on the bond side, we kept the positions as they were, but on the equity side, where the conviction is high, we increased it. The main reason behind the large drawdown was, apart from the size of the correction in itself, was under appreciation of the upcoming market correction. I think we have been following the coronavirus for quite some time, but the indications that we got from China, both in terms of death rate, in terms of number of cases, and also in terms of market behavior, the market in China held up quite well. We expected a correction to happen in Europe in the order of 5 to 20% only, whereas what happened was 40%. Why did we expect only 5 to 20%? Because unlike in 2008, companies are not going bankrupt. In 2008, although the market valuation was extremely attractive, you didn't know if the companies you were buying were going to survive or not, whereas in this situation, it seems to us that the situation is easier in the sense that after this drawdown, we're quite confident that companies will rebound. So after having missed the initial opportunity of cutting our positions right at the beginning of the correction, we decided to stick to our guns, to hold the positions, and then when the correction was sufficient, we started increasing the markets. So the positive news is that despite the fact that we have quite a large drawdown, we expect that the recovery time will be much shorter this time. And I will try to convince you now that I think what we're seeing in equity markets is really a multi-year buying opportunity. Market outlook, as usual, we follow our scheme of looking at short-term, mid-term, and long-term indicators. We start with the long-term valuation indicators. This is the DAX index. The DAX index has now fallen, you see, vertically, and we are now currently at the level last seen in 2013. I would like to mention the fact that even before the correction, I think back in January, we were at levels that were comparable with what we had already seen in 2015. So, and that was one of the reasons why we were reluctant to cut a position in European equities. Looking at the valuation, this chart shows the price to book value of the German equity market over 50 years. It goes from 1973 until today, and you see that we are now the level of 8,400, which we touched several times, corresponds to price to book value of 1. And this is the same valuation that we had in 2008, and in 2008 we then had a 276% rally. It's also the same valuation that we had in 2003, where we had a valuation of 200, where we had a subsequent rally of 256%. I would like to point out, if you look closer in 2002, you see that the level was touched 2 times. So it looks easy in hindsight, but once you were there, it was a really excruciating 3 to 6 months to basically until the market held and started going up again. So it is an attractive entry point, but it's not going to be easy. Even more striking is the DJ Euro Stoxx 50 futures on dividends, and I will explain what it is. But you see that here we are talking about levels that were the same as in 2009, so it's 11 years back and during the worst time of the crisis. Now the Euro Stoxx 50 is an index and the companies pay a dividend, and once you aggregate all the dividends of the DJ Euro Stoxx index for 2019, you get to a value of 122. So the futures on dividends allows you to buy in advance, to buy in 2024, to buy today the dividend that you will get in 2024. And today this contract is trading at 66. So we obviously don't know what the dividend is going to be in 2024, but if it's higher than 66, then we're going to make a positive return, and if it's lower, we're going to lose money. So in the table below, we summarize some possible assumptions. So if I follow the analyst forecast level for each of the companies, and then I do the sum myself, I come to a forecast level of about 175. That represents a 165% return over 5 years and 30% per annum. As you know, analysts are often too optimistic, so if we take two more conservative assumptions, so if I take an increase by 2% per annum, which is what we have seen over the past 6 or 7 years, we get to 135. If we say the dividends are going to be flat, we get to 122. And under these two assumptions, we have a yearly return in euro terms of anywhere between 18 to 21%, and that's our base case assumption. But even if you assume that the dividends will fall by 2% per annum, and as you know, companies are very reluctant to cut dividends, we get to 15% per annum over 5 years, which we think is a very attractive return. A sector that is even more distressed is the oil and gas sector. That's the DJ Stoxx 600 oil and gas sector. You see here that we are dealing with levels last seen in 1996. I mean, here, this is a perfect storm of coronavirus, plus we have the ESG trend, whereby investors tend to underweight this type of CO2 emitting sector. And the third, we have the price war now happening, whereby the oil price now trades at around 25 or so. Here, the situation is more attractive, but more difficult as well, because you really have to ask yourself, when you buy one of these companies, are they going to have to make rights issue? So are you going to be diluted if you buy now? Should you buy now? Should you wait for the rights issue in order to buy? But this is just to show you what type of exaggeration we are seeing in the market today. On the other side of the spectrum, this is the yield of the German 30-year government bond. And during the crisis, we touched minus 0.56. Now, minus 0.56 times 30 years is about 17. So it means that you buy 100 today, and you get over the lifetime of the bond 83 back, and most of it you get it in 30 years. So this is the type of polarization that we are seeing today in the market. And this also explains our positioning. So I would like to show one last chart. Maybe there is always also some downside risk. This is the valuation of the U.S. market. You see that the price to book value is now back to fair levels. It's 2.7. A large part of the U.S. economy is a virtual economy, so it's an economy that is resilient, but still the pandemic in the U.S. is just beginning, and so we could imagine, if things get out of hand in the U.S., to see a bigger correction in the U.S., and therefore European markets, although already undervalued could become even more undervalued. I would now like to go into the midterm monetary indicators, and here we have a number of very positive signals. I think central banks and governments are both acting in concert. I will illustrate the Federal Reserve through charts later, so I will jump this point. But the European Central Bank this morning announced 700 billion of purchases, of asset purchases until the year end. That adds up to, or if you divide it by the 8-9 months that are left, it's 80 to 90 billion per month. This is very large. It's as large as the quantitative easing used to be. It used to be 80 billion. And then we have governments announcing fiscal stimulus packages. So we have France, 300 billion, Germany, 550 billion, US, 1,200 billion, and UK, 350 billion. To put these things in perspective, the economy of France is 3,000 billion, so that's the GDP. So 300 billion seems huge. It's 10% of GDP, but in reality, it's loan guarantees. So it's big, but we don't know if it's going to be large enough. In Germany, the economy is 4,000 billion GDP. 550 is about 13-14%. So this is going. It's bigger, but here as well, it's state lending. In the US economy is 20,000 billion, so it's about 5 billion, 5%. So the US, the Federal Reserve has acted first by cutting interest rate twice, down to 0 to 0.25% bracket. So we are back to the 2009 level, and it has announced this is the balance sheet here of the Federal Reserve System, and it shows the different quantitative easing programs. Where the red arrow is where we are today. We used to have a program of purchases of short-term paper of 60 billion per month, and this has now been expanded with an additional 500 billion, not per month, but over the period, of treasuries and 200 billion in mortgage-backed securities. So we are back to the levels of QE3 and even more. So this is very positive. I would like to go into technical indicators. I will not show you charts of oversold markets, but I would like to, I think in the short term, what is going to drive the market are the possible catalysts. So on the positive side and then also on the negative side. Positive right now and already in the cards are the government announcing large fiscal packages and of course the central banks announcing an aggressive expansion of their balance sheet. So this is very positive. We have then positive in a matter of weeks, the peaking of the Italian pandemic statistics, the number of daily cases and number of daily fatalities. I think what is happening in Italy is quite remarkable. We have as many deaths. We have just passed the 3,000. We have as many deaths as in China for a country that is 20 times smaller than China. And I think this can only be explained by numbers of cases that are much larger than what the official numbers say. So here, I think the fact that a large democratic country can bring this under control when there will be the turning point, it will be, we think, very positive for the market. Then positive in a matter of months would be the peaking, of course, in the US pandemic statistics. That would be the definite end of the bear market. And positive, so all the news about drugs or vaccines are really 12 to 18 months away. So we think here we have to be more cautious. There are also negative triggers, of course. What if the US pandemic gets out of control? I think right now the US are starting to act quite rapidly, but we need to look at the numbers. And I think more worrying, as far as we're concerned, is the last point at the bottom. What if the Chinese have now gone back to work, and it's possible that that will trigger a rebirth of the pandemic in China, and that would mean that then the pandemic is not going to be just a matter of 6 months, but a matter of 12 months, and that would be the ultimate negative trigger point. We also have penciled in negative in a matter of months, high-profile bankruptcy, but we think this is relatively unlikely at this point. The governments stand behind their large companies, and so we're not likely to see a Lehman Brothers event during this correction. So investment conclusions, I will first summarize what we just said. So catalysts, short-term catalysts are really to look for over the next few weeks is a turnaround in the Italian pandemic, and in a matter of a few months, the turnaround in the US pandemic. On the negative side, I really point out again this risk of a rebirth of the quarantine, rebirth of the pandemic in China. Medium-term indicators, here we have really both the governments and the central banks that stand behind the economy, and I would rate this as maximum positive. And long-term indicators, we have European equity markets trading at valuations at or close to 2009. This is also extremely bullish. We then have a lack of alternatives to equities. I mean, you can stay cash for a couple of months, but in reality, government bonds do not offer an alternative, and non-government bonds are also, due to their illiquidity, an area that we would not like to add aggressively into at this point in time. In terms of investment scenarios, we have an investment scenario with a weight of 40% in the middle, which is called the coronavirus outbreak continues, but market volatility falls as the disease is better understood. So we have on one side these concerns about the coronavirus, but central banks and governments acting. And so we expect a period of high volatility, plus minus 5% per day, which will then come down as the population learns to live with a pandemic. And then we have a positive scenario. I think the main trigger that we're looking at today is an inflection point in Italy. And so this could trigger very quickly a rally of 25 or even 30% especially in European equities. We then have a more cautious scenario as usual. And here is the two main dangers is if the US pandemic gets out of control, or if the Chinese pandemic restarts. And here, I think particularly at risk is more the S&P 500 more than the European markets that have already corrected. In terms of positioning, relatively little has changed. We have decreased our US dollar exposure by 4% during the correction. We maintain our short on the US 10-year treasuries. We have long biotechnology and long equity growth basket, 5% each. These are long-term positions. We increased the Euro Stoxx dividend future from 5 to 9%, and the other positions are unchanged. Long Japanese equities 2.8, long German equities 2.9. So in conclusion, I mean, first, I would like to say that we're sorry about the current drawdown. You expected better from us in the past, but I would like to reassure you that I think we are positioned to recover the value rapidly when the markets recover. And also, I hope that I've convinced you of the enormity of the buying opportunity in terms of valuation for the equity markets. So quite a heavy message today. I have a small database of market wisdoms that I carry with me, and I use them to guide me in the market. So the ones I'm using today is buy low and sell high. I know it seems obvious, but we all know if you work in this sector, you know how difficult it is to actually implement. The second one is if you're going to panic early. Yes, of course, we should have sold 4 weeks ago. We didn't, and now we have to live with although we are quite cool in our head, we live with a physical pain of losing the money of our clients. And the third point is markets can stay irrational longer than you can stay solvent. Yes, we have to buy, but we still have to be cautious. You have seen we have increased from 26 to 33. It's not a crazy level. It is dangerous because we still have potential downside looking forward. But the last thing is to say nobody rings a bell at the market bottom. we will only know in hindsight when the market bottom will be. And we expect the rebound to be extremely rapid this time, because once the markets are so oversold that we could see within 2-3 days 20 or even 30%. I would like to thank you at this point in time, and I will pass the word back to Phil.
Thank you very much, Lucio, for the clear statements, also for the reassurance. Maybe to wrap it up just with one question, if you could just elaborate on outflows. Have we seen, related to the Corona crisis, any recent outflows?
No, we've seen. I think it's been quite stable. We've seen small daily outflows, but nothing. With the exception, we had one large client that redeemed. But in his case, he redeemed in order to buy equities, which I think it was a good move. It's a good thing, and I think that's also my message today. I think. Whether within maybe global macro or elsewhere, I think it's important to have a higher equity exposure today. I know it's difficult to do, but that's the right thing to do, I'm convinced.
All right, thank you very much. As I mentioned before, the PowerPoint and the audio file will be sent to you. Your contact person at Bellevue remains at your full disposal, independently from where we're working, be it home office or be it the regular office. Thank you very much. Have a wonderful day. Stay safe and take care.